Hey everyone, and welcome to the Landlord Studio podcast. The show is all about giving you the best real estate advice from industry leaders across the US so you can learn and grow your real estate business and build long-term wealth. Let's cue the intro. Before we jump into today's episode, make sure you smash that subscribe button so you can get notified of every episode we release. And in today's episode, we're interviewing Mr. Marco Santarelli. Is that how I pronounce your last name?
That was pretty darn good, Logan. Yes, Marco Santarelli. Unless you're Italian, it's hard to say Santarelli.
Santarelli. I like that. I like that accent, though. So Marco Santarelli is an investor, author, and founder of Norada Real Estate Investments, an Inc. 5,000 national real estate investment firm offering turnkey investment property and growth markets throughout the United States. He's also the host of the Passive Real Estate Investment Podcast, the show where busy people like you learn how to build substantial passive income while creating wealth for the long term. How are you going today, Marco?
I'm doing fantastic. How about yourself, Logan?
I'm doing great. It's an interesting time being in quarantine, but nevertheless, it's nice to be home. So I was like starting off my my podcast with a bit of an icebreaker question. What's your favorite quote and why?
Well, it's actually something Warren Buffett said. It's if you don't find a way to make money while you sleep, you will work until you die. And the reason I like that quote so much is because it really makes you think about how critically important passive income is, and it's something that I love and I have and I teach people how to create. And if you have passive income, it doesn't mean you're necessarily rich or wealthy, although you can be very wealthy, but it gives you the time freedom, which is something that we all want. We want to be able to do what we want, when we want, on our own terms. But in order to do that, you have to have financial freedom, because that leads to what ultimately we want, and that's that time freedom. So I'm all about passive income, and that's why that quote is so brilliant.
Yeah, and it's really kind of applicable in today's market, right, and everything that's going on. So tell me a little bit about your journey and how you kind of got into real estate. When and how did you get started in investing in real estate?
Wow. Well, if you want to go back that far, I actually bought my first rental when I turned 18 years old. And that was actually in Canada. I wasn't even in the US. So I turned 18. I could qualify for financing. I bought my first townhome unit, required a little bit of work, fixed it up, leased it, did it all myself in terms of the leasing and the management of it. It was pretty much textbook, even though I didn't like take a course or really study it. It kind of came naturally, but the writing was on the wall at that point in time. And so I continued on. I got my real estate license. I bought my next rental property and a condo at the time. And I just carried it through. Fast forward to 2003, I kind of went over the whole dot-com implosion that happened in 2000, because I was in the tech industry, and I was a third co-founder in an IT company. And what you thought was going to be millions of dollars just vaporized like a flash, when the stock market crashed, when the NASDAQ crashed. So paper millionaire, just happened and disappeared overnight. So I've always loved real estate, and I wanted to get back into real estate. I thought, real estate is just really the place to create wealth and that financial freedom. Plus, I just enjoyed it. So I got back into it full time in 2003 and 2004. An interesting thing happened, though. In a 9-month period, starting at the end of 2003, I actually acquired 84 doors, 84 units.
Oh, wow.
And that was pretty fast for a 9-month period. But what was happening is investors, or people who wanted to be investors, were coming to me saying, "Hey, Marco, I see what you're doing. We're all taking the same boot camps. But can you coach me? Can you mentor me?" And I said, "Well, I appreciate you asking, but no, I don't have the time. I just can't. It's just not going to happen." But that's the light bulb moment that went off. I realized that there is a huge need and demand out there for people who are spending tons of time and money educating themselves, which is great, because it's my number one rule for successful investing. But there's still a gap in terms of providing quality turnkey investment properties in good markets. So I wanted to be the guy at the end of that food chain, if you will, that was providing that inventory of quality properties and investment opportunities, and not be the next guru, teaching people, how to invest in real estate. There's a lot of books and other stuff for that. So I was an investor. I was investing full time, and then I saw an opportunity. I thought, oh, let's become a provider of turnkey rental properties on a nationwide basis. So that's my journey from 18-year-old to and
Yeah,
beyond.
that's awesome. So is that kind of how it naturally led into starting Norada Real Estate Investments? Tell us a little bit about your company now, and what do you kind of offer, and how did you kind of get to where you are now?
Well, that's exactly how the business was started. Is people were coming to me asking for help, and I said, I can provide you the deal flow. I can be your acquisitions person, and ultimately I ended up being everything to those people because it's all the resources. It's the lending, it's the management, it's the tax advisors, it's the asset protection attorneys. It's anything and everything you want to be successful. But that was 16 years ago. Where we are today is, as a company, we have a footprint into about 25 markets, mostly in the Midwest, Southeast, and pockets of the Northeast, and those do include Florida and Texas. The markets we probably our investor clients purchase anywhere from 400 to 500 units per year, so we're moving a fair amount of volume in terms of housing. And these are duplexes, single-family homes, and fourplexes, mostly single families. But they're all in good markets, in good neighborhoods, cash flow positive, professionally managed. That's our definition of what a turnkey investment property is.
Yeah.
So when someone comes to us, we provide them tons of value and education and content and resources to succeed. And then ultimately, when they've got that strategy session done and a game plan mapped out, and they know clearly where they are and where they want to go, then we start introducing them to the markets and the properties and the providers and team that we have in those markets to start building or growing their real estate portfolio. And all that comes for free. As kind of a side note, we don't. Some people wonder, whoa, that sounds like an expensive service. Well, actually, no, it's free. We don't charge for it because we operate as a brokerage and we're compensated on the sales side. So that allows us to be unbiased. We're agnostic. Yeah. We're not married to a market. We're not married to a provider. We're not married to anything or anybody. So it allows us to be nimble.
Yeah, totally. That's really interesting. And I really like the journey of how it kind of came from you starting out investing in real estate as a kind of a young person, and then how it naturally led into now offering that as a service to help other people achieve what you've managed to achieve. I think that's really cool. A specific question from one of our kind of customers, and this kind of might go into how successful they can be with their specific property. The question is what key metrics does an investor need to track in order to measure the performance of their investment properties? What kind of key specific things do they need to be monitoring on a daily or weekly, monthly basis?
That's a very good question. And I'll tell you why it's a very good question is because different investors look at investments and investment property specifically a little differently. And there's different metrics that they could use to measure the financial performance of a property. Unfortunately, some people are kind of stuck on one and they don't see the whole picture or the big picture. I'll give you a great example. A lot of people look at properties from the cap rate, the capitalization rate, which is a very one-dimensional way of looking at a property because it's assuming you're buying a property all cash, or it's asking the question, what would my cash-on-cash return be if I just bought it all cash, no financing? And often you're going to find that to be around 7-6%. If you're lucky, maybe 8%, sometimes more, but often it's going to be less. And that's dependent on the market and more specifically on the submarket and neighborhood within a market. So it's very hard to compare apples to apples, as using a cap rate because it's very location specific. But at the end of the day, it's what is the return on the money I'm investing? So the cap rate is a starting point. A better metric is the cash on cash return because that's showing you what is my leveraged return if I put 20 or 25% down. So the cash on cash return is a better metric than the cap rate alone. But you do need to take it a step further because the beautiful thing about real estate is it's not just about the cash flow, which is the return on your cash. It's also about what is the growth in equity each and every month, every year, and over time. Because now, if you understand that equity is usable, it's a gain. Maybe it's not a realized gain, but it's a gain. And you can actually leverage that into more property or turn it into other investments. You got to look at that as well as a return. And when you do that, you get what we call, or what investors call, a total return on investment. So you've got your cash flow, which gives you a cash on cash return. And then you've got your equity growth, which, again, if you compare that to your down payment, also gives you a rate of return. If you combine those two things together, you have a total rate of return. And often with quality investment real estate, that's in the 20-some% range, and often in the 30% range. But I'm going to mention two more things to kind of really round out the answer to this question for completeness for your audience.
Yep.
One is, for a lot of people, they benefit from the depreciation, the tax benefits of real estate, which at the end of the day lowers your net income, what actually flows to your pocket, because you can reduce or eliminate the tax impact of the income from your rental properties because of that depreciation. But wait, there's more, as they say in the commercials. There's another powerful thing about real estate that a lot of people don't even think about, not even think about, they don't even know about. And that is this. If you look at if you buy a piece of rental property, like a 3-bedroom home or a duplex or a 4-plex, and you have a 30-year mortgage on it, right? You put 20% down, you get an 80% loan. What a lot of people don't realize is that that mortgage is being paid down each and every month and each and every year, which adds to the equity. I already said that the equity is a rate of return. It's unrealized. It's trapped in the property. It's like a forced savings account. But if you do the math, if you look at what your annual rate of return is, as if you were measuring it that way, over the course of 30 years of amortizing that mortgage, it works out to be 13.3%. It's lower in the first year because you're paying more interest than principal, and it's a lot higher in the last year because you're paying mostly interest and very small amount of principal. But if you average it out, it's 13.3% over the course of that 30 years. If you think about that as a rate of return, it's amazing, because even if you had no cash flow, like zero cash flow, and you had zero appreciation on that property, and you only benefited from the amortization of the loan, over the course of 30 years, it works up to 13.3%. And it's about 5% in the first year, just that alone. But wait, there's more. It actually even gets better than that. And this is the thing that people don't even know about. Inflation is your friend. If you understand that when I buy my 3-bedroom rental property today in, let's say, Kansas City or one of my markets, and I have a $500 mortgage payment today, I'm going to have that $500 mortgage payment every month. My tenant's paying it. I'm not paying it. My tenant pays that, that through their rent. But what happens is this, that $500 today is fixed. So in 10 years, 5 years, 15 years from now, it's still $500 a month, right? It wasn't adjusted for inflation. So I'm actually paying that off with cheaper dollars in the future, because the loan is being eroded away each and every year because of the effects of inflation. So that loan has become worth less each year. Even though my payment is the same, my rents are going up, the property value or price of that property keeps going up, not the mortgage. The mortgage stays the same.
Yeah, that's really interesting. It kind of leads quite nicely into the next question, and it's around getting further finance to increase your portfolio size. So customers are always looking to try increase their portfolio size and buy more rental properties. What kind of financial data does an investor need to track and then provide in order to get that further financing so that they can keep increasing those rental property numbers in their portfolio?
So I know you're in New Zealand some of the time. Are you asking about that from a foreign investor's perspective or a resident of the U.S.?
A resident of the U.S., yeah, specifically.
Okay. So the general rule of thumb is this: every person, every resident, every citizen in the U.S. can qualify for conventional financing, conventional loans. Those are the loans that come from Freddie Mac, Fannie Mae. It's the entities we know as GSEs, or government-sponsored entities. They're technically not the government, but they're entities that are, regulated by the government. It's the market, the public market. So those conventional loans, you are allowed to get 10 per person, per credit score, per social security number. So those are the best deals. It's the cheapest financing. It's 30-year fixed rate mortgages with the lowest overall interest rate. So that's where you start because it's cheap money, right? Once you tap that out, you and your wife, once you've tapped those out, now you move on to portfolio lenders. These are usually asset-based lenders. So they're still looking at you and your ability to qualify, but they're not as stringent. Not that the conventional financing is overly stringent. You just have to prove your income, with two or 3 months worth of bank statements and a W-2 slip or something. Just to, you need to just prove income, and you need to prove your credit, and that you just pull credit and you have a credit score, and they go off that. And it's not that difficult to qualify. But once you've tapped that out, now you go to a portfolio lender, a private lender. And the theoretical limit on conventional financing is unlimited, because they're looking at you, but they're also looking at the asset, the property. And as long as you fit inside their box, then as long as they've got capital, they'll keep lending you financing. So it's a little bit more expensive interest rate wise than conventional financing, but not that much. The deals still work, and there's plenty of that money out there. So people should not be concerned about those limitations. We work with plenty of lenders. No one's ever hit the wall, so to speak, run out of, finance capital.
Yeah, for sure. And it's I guess it's quite applicable to today's market and the downturns and the ups and downs that we're seeing, and the mindset that people need in order to, take advantage of those situations. Because there's lots of people that are, I guess, skeptical or they're all in on investing in rental properties. So I guess it's really how much you understand about that, right? And how much risk you're willing to personally take to then invest in those rental properties or into that market. So Norada Real Estate Investment been around for about 17 years. Is that correct?
Yeah, we started January of 2004.
Yeah,
so that's 16 years.
Yeah.
Wow.
So you would have experienced a lot of ups and downs in the markets over the years, and many of our customers have faced a large increase in rent arrears due to like COVID-19, and they've had to use our software to keep those, and they hope to recoup some of this income at a later point. What advice would you give to these real estate investors that have been impacted by a downturn, by COVID-19, or by any downturn?
Well, the advice has to come before you buy the property, because then you can weather through, any kind of upset or real estate market cycle or catastrophe or COVID-19 or riots and whatnot. Yeah. The thing is it's about buying right, because when you buy, and this follows my 10 rules of successful real estate investing. What I'm about to tell you kind of covers like 3 or 4 of these rules at the same time. If you're buying investment property that makes sense the day you buy it, you're not gonna have issues, or very few issues. Here's why. Well, here's how and why. The key is to buy in a good market, a market that has strong fundamentals, has population growth, has job growth, because that's at the heart of it. When you have jobs and job growth, people want to live there and move there, and that increases demand. And as long as you have that demand, you have stability in the rental market, the housing market, in that local market. So when you have that stability, you have, demand, you have, a rental pool, et cetera, et cetera. So it starts with the market. Then you need to look at the submarkets and neighborhoods, because this is where you control and mitigate a lot of your so-called risk in real estate, is just buying in the right locations, the right markets, specifically the right neighborhoods. I tend to like growing markets with strong jobs and job growth and population growth. Ideally, it doesn't have to be growing population-wise, but as long as it's stable. Then I look at quality neighborhoods, like what I'll label as a B+ neighborhood. I like to stick to like your B- Bs, B+, A-. This is your blue collar workers, your stable bread and butter, middle income, middle class neighborhoods, because you have a very large pool of people who want to live there, and a very large tenant pool. You've got jobs, decent schools, low crime. These are areas that are what I refer to as desirable. And if you're in a desirable area, it has been for years, decades, it'll continue to be desirable. So neighborhood quality is very important. So market, neighborhood, then you look at the properties, and then you have the right team wrapped around all that. And we talked about team before. Your number one player on that team is your property management company. So when you have those ingredients, you've mitigated problems, you've mitigated risk. And here's what it leads to. When you have COVID-19, when you have an economic cycle, a recession, you have a local up and down in that local market because of the real estate is local and you have that cyclical nature. You're going to weather through that. It's just rough tide, rough seas, or however they say it, just kind of rough weather at sea. But the key thing here too is that you want to have positive cash flow from day one. It has to make financial sense. The reason I say that is this: cash flow with a rental property is the glue that holds your deal together. Regardless of what's going on in the market, if you're in a location that has desirability, you have constant, demand for tenants. When you have cash flow, when you have positive cash flow, you have someone paying, that monthly rent, you weather through these cycles. Sure, rents might, adjust a little bit up and a little bit down as things change. Property values might go up, might go down, but who cares what the property value is when you're going through a cycle, because you've got the cash flow, and over time, that property will be worth more over time than what you bought it for, as long as you're not in a bad area. So the key is to buy smart in the right location, right market, right location, but have positive cash flow, because as long as you're cash flow positive, you can weather through real estate cycles. You can weather through economic cycles.
Yeah, I mean, that's great advice, and it really ties into how I guess real estate investors just getting into it now can actually prepare themselves for the long term, and also weather through those kind of future downturns, because in the end it's inevitable that at some point there's going to be some sort of downturn. So being as prepared as possible is definitely key. Well, I really appreciate you coming on today, today's podcast, Marco. Where can our audience find you? And if they would like to find out a bit more about you, how can they do that?
Yeah, thanks for asking, Logan. And it's been a real pleasure being on your show. Really, the two websites we have is the best place to find me, my team, and all our downloads and resources, and the free book that's coming out, which is titled after the podcast. So the book will be called Passive Real Estate Investing. So the two websites are noradarealestate.com, Norada, noradarealestate.com. And the other website is a little easier to remember, and it's named after the podcast and the book, passiverealestateinvesting.com. So if you could remember that, it's easy to find.
Awesome. Well, thank you everyone for listening into today's podcast episode. Make sure you smash that like button or subscribe button below so you can get notified of every episode that we release. Appreciate you coming in today, Marco, and all the best for the future.
Thank you, Logan. I really had a lot of fun. Appreciate it.